Greetings. My name is Paul Ried. You're about to hear the remarks from our keynote speaker at our most recent client event, The Economy and Your World 2017. Our speaker is Dr. Brian Portnoy. He's the Director of Investment Education at Virtus Investment Partners. He's best known for his research and writing on the relationship between emotions, investor behavior, and portfolio return. He's an author with a book on the same topic titled The Investor's Paradox: The Power of Simplicity in a World of Overwhelming Choice. On behalf of your financial team, we hope you'll enjoy his remarks and find them informative and insightful.
How's everybody doing today? This is a special event. So I have the privilege on behalf of Virtus to travel the country and meet investors and financial advisors, regular folks like you and me, friends and neighbors, and to have a group of this size in such a beautiful room with amazing views. This doesn't happen in a lot of places, so consider yourselves quite fortunate. It's actually quite cool. What I want to talk today about is investor behavior. So I've spent a good chunk of my career in the markets making investment decisions. And as I've grown and I think evolved over time, what I've realized is that it's the psychology of it all versus the financial details of it all that really drives long-term success. So what I want to do today is kind of give you a quick tour of the brain and how the way our brains have developed either get in the way or help us make better investment decisions. One thing I want to point out is that my least favorite word in the field of psychology or behavioral economics or behavioral finance or investor psychology, all synonyms for basically the same thing. My least favorite word is irrational, okay? And why don't I like that word? It's because really nobody is irrational. What we are is human. What we are is normal. And what I hope to, I want to make sure that you all walk away with the sense that we actually all struggle with a lot of the same challenges as it relates to our money lives. Not just investing, but how we earn money, how we save, how we spend. It's both not only intellectually complex, but it's emotionally challenging. It's something that we all struggle with in terms of how to make the right decisions. Financial education, financial literacy, it's not even a thing. We're not really trained to think and talk and to operate on these matters. And so in a sense, we're alone but together. And I want to point out that a number of the biases that we have, we all have them. We're all struggling with these. And sometimes it's useful just to talk about them out loud in a nice, small, intimate group like this. What I want to do today, for the most part, is talk about some very simple rules of investing. Okay, so if you turn on CNBC, which I really wish you wouldn't, you're going to see stuff moving all over the screen. I mean, Bloomberg TV's even worse. Like the person's in a small box. I once counted. There were I think there were literally 29 data points on the screen at any one time. And so, we think of finance as being relatively complex and relatively complicated. And there are actually many vested interests in this industry that want you to think that this is very, very complex. And to some extent, it is. What I want to do today is simplify the world a fair bit, but then also have everybody appreciate that simple doesn't mean easy. All right? Simple doesn't mean easy. These are 4 very basic rules. I'm gonna boil all of investing success down to 4 basic rules. Buy low, sell high, own a diversified portfolio, know what you own, sort of be a smart consumer, and invest for the long run, be patient. Anyone here object to any of those 4? I've literally never had anyone raise their hand. So I don't know what I would do. I would be polite, but disagreeable. Which is how I think my wife describes me. All right, so we're going to walk through each of these, and they all sound very sensible. Our brain is wired to do the opposite of all 4. So it's easy to say these out loud. It's hard to actually execute. So let's walk through kind of the way, walk through some brain science. And then we're going to wrap up with why this actually works out pretty well in the long run, because there's some things that we can do and not do to get us to a better place. All right, so the first one's a biggie. It's sort of finance 101. You buy low and you sell high. Here's the deal. There is a massive amount of evidence to show that we do exactly the opposite all the time. Let me give you a slide here. This is the most numbers and the most technical thing I'm going to give you all day, so you're kind of off the hook. The number on the left is what the S&P 500, which is a proxy for the stocks of big U.S. companies, what the S&P 500 has done over the last 20 years. It's returned almost 8% a year, which is a little bit sort of in the vicinity of what the long-term return on the stock market has been. And so that's straightforward. That's just what the quote-unquote the market has done. The number on the right in lighter blue, 4.8%, that's a little bit more complicated. Let me explain to you what that is. So there are data services and research services that track every dollar that flows in and out of the market on a daily basis. So while the market does whatever it does, we as investors were putting money into funds, we're taking money out for any number of reasons. And what these data show is that we actually underperform our own investments by close to 3% a year for the last 20 years. Okay, so it's a really strange thing that I just said. We underperform our own investments. What could that possibly mean? All right, so let's take our kind of first stop on the tour of the brain, which is that we are hardwired for the cycle of greed and fear. Okay, sort of the deepest, most foundational elements of the way our noggins operate is that we are here to survive and thrive in a dangerous world. And so going back many, many tens of thousands of years, we developed a sense of whether we wanted to fight or whether we wanted to flee. And so we as humans, as by far the dominant species on the planet, we have that instinct that when there's opportunity, we want to move forward, and when there's danger, we want to move away. Okay, so part of the problem that we all face, and again, we're sort of alone but together on these challenges, is that we, when the market is that our hardwired brain, when mapped up against modern capital markets, there can be a real disconnect. So when the market is trending upwards, we feel good. I mean, honestly, right now, we're in the midst of the second longest bull market in modern history. Okay? It's been going on for 8.5 years. It bottomed on March 9th, 2009, and it's been going and going and going. All right? And so when things are relatively good, we feel comfortable not only maintaining our portfolios, but investing more. It feels good, right? It's not necessarily greed, but it feels comfortable. The flip side is when things get rocky. And this is the most smooth, the least volatile equity market we've seen in decades. All right? There's barely been a ripple on the water. But in some ways, 2008 feels like it was just a few weeks ago. Everybody can remember kind of the aggravation and the pain of that experience. And the last thing we were saying to ourselves or to our neighbor or to our financial advisor was, oh, the market's getting really cheap. Put me in. This is where I want to go. No, we're worried. We're not investing more, and we're probably selling. In point of fact, if you look at the flows in and out of the stock market from the 2008 crisis forward, flows in aggregate didn't turn positive until 2013, meaning that as people sold out of the market in 07, 08, into 09, in aggregate, money didn't really flow back into the market 4 years after the market bottomed. Okay, and you think about a lot of the gains that were left on the table. So when I talk about buying high and selling low as being just part of who we are, it's that greed and fear cycle kicking in. One of the points I want to leave everybody with today, for sure, is that those who work with financial advisors tend to have much better financial outcomes than those who don't. And respectfully, that's not because financial advisors are market gurus and can predict where the dollar is going to be or whether Bitcoin is real or what a barrel of oil is going to cost or so on and so forth. The real value of the financial advisor in 2017 and beyond is as behavioral coach. So if you think about the fact that we collectively have underperformed our own investments by 3% a year for 20 years, the job of your advisor, who you're partnering with, and we're going to talk about that partnership today, their job is to keep you from being the worst version of yourself at the worst possible time. Okay? And we all have that worst version. Tim pointed to a book that I wrote a few years ago. The big theme of the book was that I was terrible at my job. Not a particularly good investor, but I wrote a job about how everybody else is bad also to make myself feel a little bit better about it. But this influences all of us, not just folks like my dad or my friends or my neighbors, but financial professionals, even the so-called experts. All right, so we're 0 for 1. We buy high and we sell low. The second thing we want to do, and this is conventional wisdom, is that we want to own a diversified portfolio. All right, so there were a bunch of fancy equations written at the University of Chicago in the 1950s. I wasn't there at the time, I was a little young. And what those equations, somebody got that. I was waiting for it. And what those equations basically said, and multiple Nobel Prizes have been won on the back of that research, was that we shouldn't put all of our eggs in one basket. All right, it's not only the best investment advice we have, it's really the only way to build a portfolio, short of, as they say, having a hunch and betting a bunch. You know, oh, I think that social media is the future, so I'm going to put all of my portfolio into those sorts of stocks. We know that's probably not the prudent way to do it, so we want to be diversified. A lot of you, either with Paul and team or generally, you've seen this quilt diagram, and for those who haven't, I can explain it very simply, which is that each colored block refers to a different segment of the market. Big cap stocks, small cap stocks, stocks versus bonds, US versus international, and so forth. Different strategies and styles. And what you can see from sort of the patchwork quilt is that there's a certain randomness to corners of the market that do well versus those that do poorly. And precisely because we don't know what's going to happen next year, we spread our bets. Okay? It seems very, very sensible. The challenge is that there is some brain wiring that actually makes diversification quite uncomfortable. The Devil's Dictionary definition of diversification is that something in your portfolio always stinks. All right? If everything in your portfolio is working, you're either incredibly lucky or you're just not diversified. So to have a truly diversified portfolio, it means that something is quote unquote not working or it's losing money, and we're not very comfortable with that. One way to, so the math of diversification makes all the sense in the world, but the psychology of diversification is unsettling. We don't like it. One way these days we want to get at different perspectives on old problems is just by thinking about them differently, by drawing the picture differently. So I did. Now, oddly enough, this picture and this picture, are the exact same, flipping back and forth. Okay, so they're the exact same. The difference, there are two key differences. In this picture, what I did was I just showed you the top performing strategy and the bottom performing strategy, and much more importantly, I put it on a cardinal scale. The challenge here, because this slide really reinforces the value of diversification, but there's no emotional resonance to it. It just shows you that some things do better than others. What this does, when you put it onto a scale, you could see that in any given year, the best outperforms the worst by 30%, 40%, 50%. A lot of conversations that take place between investors or clients and their financial advisors revolve around the fact that, hey, you had me in some not so good investments. Why didn't you put me in those better performing investments? The financial advisor shows you this chart. You shrug your shoulders and you ask the question again, why didn't you do that? Here's the reason. And it goes back to brain wiring. Our brains are wired with something called loss aversion. It's one of the most important biases that works not only in our money lives, but across really every domain. And it's really the idea that losses are more painful than gains are pleasurable. Okay, a moment of honesty here. Anyone ever been to a casino? I saw 2 hands, but a lot of laughs. Okay, they're like waving their hand. Yeah, they're really into it. Okay, so, when you go to a casino and you make a few bucks, that's great. If I won a couple $100, I would take my wife Tracy to dinner and we would have a nice time. But if I lost a couple $100, I would be miserable. Number one, I just lost $200, and two, I'd have to explain to Tracy why I was at a casino. And so we're really struggling at times with sort of that just bad feeling we get when things don't work out, but we're not as happy with the upside. And so this notion of loss aversion is really important. Social psychologists have studied this extensively. And the sort of common ratio that studies come up with is about 2 to 1. So in other words, a $100 loss feels twice as bad as a $100 gain feels good. Does that resonate with some of you? Okay, everybody's shaking their head now. Okay, and so, when I say diversification is something we actually dislike, and why advisors often have to apologize for building a diversified portfolio, is that we just can't stand holding on to losers. It's triggering that evolutionary instinct that we don't want to be in danger. Okay, so we're 0 for 2. Everybody feeling good now? All right, this is the third of 4, and it's a big one. Everybody here is an accomplished individual. You've had a level of financial success, and you've done well. And as an educated, successful person, you want to know what you own across every domain, in consumption and investment and so forth. And you absolutely would insist that your financial advisor, who's a quote-unquote expert, is going to do all the requisite due diligence for the investments they make on your behalf. This seems like a pretty straightforward proposition. Here's the challenge. As we sit here today, there's never been a society such as ours that has had more information and more choice than we do. So in the history, in all of recorded history, we have more input into our minds than at any point before. And modern neuroscience is grappling with figuring out how much is too much. Okay, I'll show you what's too much, which is, oh, this thing's a little sticky. What's too much is my occasional Saturday morning at Costco. My kids are 15, 13, and 11, and I tell them not to go to the samples table, but not only do they go to the samples table, but they've literally knocked them over. My wife is buying cashews in bulk. I don't like cashews. And I am just in that middle section buying my 8th Kirkland fleece vest. I have so many fleece vests, it's ridiculous, as well as printed dictionaries and atlases. I don't need any of these. But we also know that Costco is designed in a way where you go to that middle section as sort of a release valve before you go back into the chaos of the big boxes. But whether it be Costco or Walmart or Sam's Club or Amazon, we're faced with infinite choice, okay? More than at any other point. And it can be very, very overwhelming. And it's just not in the field of consumption. It's actually across every domain that we deal with. Some that we don't even really think about the fact that we have a ton of choice. Education, for example. So I grew up outside of Pittsburgh, and K through 12, I went to school down the street. There was never a single conversation in those years about where I was going to go. So I live in the city of Chicago now, just a mile west of Wrigley Field, urban neighborhood, but nice street, single-family homes. There are 39 kids under the age of 18 on my block, and there are 15 different schools attended. Okay, so I've got 3 kids, meaning 3 problems to solve. And we have 4 or 5 public options, 3 or 4 private options, 2 religious options, and a whole new slew of hybrid technology / homeschool solutions, Khan Academy and so forth. Okay, so and Tracy and I talk about, the educational solution that's appropriate for each kid. And we are friends on the block, but also our friends in the Chicago suburbs and our friends on Mercer Island and our friends outside of Boston have the same conversation. We have a ton of choice. In medicine, all right, obviously healthcare and choice is a very controversial issue. And going back not that long ago, we now have pharmaceuticals that are advertised to us on a regular basis. I have the occasional very uncomfortable conversation on football Sundays with my sons who ask, what does that pill do? But we're past that. We're past that. But we tend to have this sense that, because we're given all these choices, we can do something with them. Anyone here ever heard of Restless Leg Syndrome? Okay, so there are more people than have ever been to a casino. That's good. There were almost no known cases of RLS before they started advertising a cure for it. It's a real thing, but the incidence of it spiked after the advertisements came out. All right, so we're relatively suggestible. And then we move into not only consumption and education and medicine, but investments. All right, if you go to Morningstar, great investment website, there are 24,000 mutual funds, 4,000 exchange-traded funds. In my old world, the hedge fund world, which is a little less transparent, there are 11,000 choices. All right, so we're dealing with a level of choice that is really quite remarkable. And then the question becomes, is this a good or a bad thing? And the answer is, well, it's both. There was a famous study done by a woman named Sheena Iyengar, who's a professor of business at Columbia, and she wrote a book called The Art of Choosing, which impacted my life both personally and professionally. It's just an elegant meditation about what choice means to us, because it's not that we're just choosing to have that good piece of pie or choosing to go on that vacation, and the vacation is what makes us happy. The actual act of choice in and of itself is valuable, and why is that? Because choice is a proxy for control. And when we have control, we feel good, and when we're out of control, we don't feel good. You ever go into an elevator and the door doesn't close? What do you do? One, you can get out. But you punch the closed door button, and many of you might know that in 2017, the closed door button is really not connected to anything anymore. But what happens in that moment, right? What happens in the moment that the door isn't closing and you need to get going? Is it really the 2 to 3 seconds that you're going to lose? No. It is an unbelievable evolutionary instinct that you have just lost control of your environment. And so you start pounding on that button because you want it to close, and the button just keeps you busy for the 2 seconds until the door closes. It's hard to understate how much choice and control is like right there below the surface and kicks in all the time. So what Professor Iyengar did with some colleagues, and this has been replicated across many different domains, is that she set up shop at like a Whole Foods with a samples table of jams and jellies. And we've all experienced this before. You walk in, there's the first week she did this, there was a huge colorful display, 25 or 30 jars of jam, and the table was flocked. I mean, think about the holiday season coming up, and the store windows, and the displays, and it's just cool, and it's attractive, and you're sort of, you move toward that. So a lot of people went up to the table, they put the jam on a cracker, and if they liked whatever, they would get a $1 off coupon, and then they would walk down the aisle to choose from the shelf whatever they wanted. The next week, they did the exact same thing, all right? They did the exact same experiment, same store, same time of day, same demographic. Everything else was held constant except for the fact that they had just a small display, 5 or 6 jars of jam, so much, much smaller. So far fewer people came up, all right? So if you think about a store display that there's really nothing there, you're not going to go to. If it's big and colorful, you're going to. When we have a lot of choices in front of us, it's a physical thing. You could measure it through brain activity, through skin temperature, through heart rate. When you have more, you get excited. But what did they find? What they found was that those who shopped from the small table were 10 times more likely to buy jam than those who bought from the big table. 10 times more likely, 30% versus 3%. They had researchers in the aisles dressed as store employees holding clipboards, taking note of consumer behavior. And what they observed was that people who bought from the big table, they were excited about what they had been sampling. They walked down the aisle and they looked at everything and they just kind of threw their hands in the air. Those who chose from the small table, they walked down the aisle and they just picked what they wanted. There wasn't really a lot of deliberation. And generally in life, we like having choice, but we don't want to have too much. So we have something called the paradox of choice. Now, this is another really good book by a guy named Barry Schwartz at Swarthmore, social psychologist. My book is called The Investor's Paradox. So I actually emailed Professor Schwartz in 2013 when I was about to publish, and I said, I hope you don't mind, I'm going to take the title of your book and use it for my book. I took his non-reply as negative consent, and I have heard from neither him nor his lawyers, so I think I'm cool. So the left half of this graph is really important and should resonate with all of us. We've known this for thousands and thousands of years, which is that when we have more choice, we're happy. But choice in this case is just code for liberty, freedom, opportunity. Think about our national ethos. What we love about America. It's that sense that we can do anything. Okay, so we love having opportunity. And without opportunity, getting back to just basic survival instinct, we don't feel like we're in a very good place. So we've known that for thousands of years. What we've known now just for 20 or 30 years based on rigorous research is that across every domain in life that there is a tipping point. Notice on the y-axis there's not a number because it depends on the domain and your personality. But we have a tipping point. We have that Calgon take me away moment. We have in American society something called decision fatigue. The symptoms are not dissimilar to depression or anxiety, and it's just the sense that we're overwhelmed. It's not something people really like to talk about, but it's bad and it's getting worse because our smartphones are sucking us into a world of infinite information and data. Okay? Smartphones in the grand scheme of things are brand new, and the neuroscience on smartphones is even newer, and the early findings are not good. It's incredibly distracting and really steals away from our productivity and even our happiness. So, all right, so we're now 0 for 3. We buy high, we sell low, we hate diversification, and we want to be smart consumers, but the more we learn, the more miserable we become. Everybody happy so far? Well, this should really help. So this is one of my worst traits. I'm not particularly patient, and which is not good for a lot of reasons, including investing. I've tried to train myself accordingly. But think about the advice that we receive from the experts, the advice you receive from your advisors. Invest for the long run. Ignore the noise. Think through it, get to the other side. One of the most famous books written ever in finance is called Stocks for the Long Run. Okay? This is just part of received wisdom. But again, this is a situation where the way our brains are wired collides with conventional financial wisdom, and brain wiring wins every single time. It's a technical knockout. All right? So let's talk a little bit about the way this part works via, I think, a really interesting study or series of studies that have been done over the last half century. There's a professor of early childhood development at Stanford named Walter Mischel, who starting in the late 60s and 1970s wanted to understand how children developed patience, willpower, the ability to resist temptation. And so what he did was set up just an elegant and clever study where he would bring a child into a very warm and safe environment, a sort of a testing room, and they would know ahead of time what the child's favorite snack was, chocolate bar, marshmallow. This has become known as the Marshmallow Test. And they would sit down little Johnny and they would say to him, hey, this treat is for you. You could have it right now, but I need to head out. I need to go out for a little bit and come back. If you can wait until I come back, and not in 2 minutes or 3 minutes, just generally later, if you could wait till I come back, you could have 2 marshmallows. So is there sort of a more elegant phrasing of our grand dilemma in life? I can have 1 now or 2 later? Okay, this is a lot of what we grapple with. Our minds are zipping around into the future and into our memory. If we can actually control ourselves in the here and now, we have better outcomes. So this is known as the Marshmallow Test. Anyone here familiar with it or seen it before? Yeah, a few of you. If you haven't, I highly recommend going onto YouTube at some point and just type Marshmallow Test, and you can watch the videos of a lot of these kids take the test. So if you have kids, grandkids, if you've ever been a kid, it's absolutely hilarious. I gave the test to my 3 kids. My 15-year-old, who's bookish and shy and appears to have gone mute about a year ago, he will just sit there and do nothing. He couldn't care less. He doesn't want the marshmallow. My middle guy, who's 5 of our 7 children, he wolfs down the marshmallow, knocks over the table, and wants more. I'll give you one guess who caused the problem at Costco. And then my sweet daughter, Sarah, who's 11, she's like so many kids in the video. Ultimately, she resists the marshmallow, but she will hover, she will pick it up and smell it. It's really a treat. So, and it's not a terrible thing if you want to give this to your kids or grandkids. It's really quite funny to observe. So the cool thing about this study is that Professor Michel and his associates, and all of this is captured in a book called the Marshmallow Test, which came out a couple or 3 years ago. They kept track of everybody who took the study for the next 50 years. So they had a longitudinal study of all these folks, and they were able, through reliable but sophisticated statistical techniques, to isolate the impact of patience on long-term life outcomes. And what they found, in some ways, wasn't surprising. Those who were naturally patient, and they found that most people were not very patient. Some were. You had a whole spectrum. Willpower varies. Innate willpower varies. Those who had innate willpower over time had higher educational achievement, higher incomes, lower divorce rates, lower obesity rates, and so forth. So if you were born that way, that is a leg up, because you're able to transcend the one now and get the 2 later. The third thing that they found, or the final third big finding, and it's the silver lining around the marshmallow, is that it's teachable and it's coachable. And to the extent that some of us, including me, aren't necessarily very patient, you can do certain things by yourself or with friends, partners, financial advisors, to resist the marshmallow, literally and metaphorically. And I want to return to that notion that as I see it, and I travel around talking to lots and lots of people like you and lots of people like Paul and his team, those who work with financial advisors have better outcomes because the advisor can help you resist the marshmallow, okay? All right, so we were 0 for 4. I gave you the most basic investing wisdom. If you did all 4 or even 3 of those 4, you would probably end up in a fantastic place. But most of us do none of them most of the time because we're human. We're not irrational. We're certainly not stupid. We're just human. This is just finance for normal people. Okay, and we are normal people. So where do we go from here? Well, I want to give some advice now on some don'ts and some do's that I think will allow us to transcend some of this brain wiring, because it does work out most of the time, despite the fact that everybody in this room struggles with the types of biases that I've mentioned. So let me walk through some of these. First of all, I'm going to implore folks here to try to not, quote unquote, beat the market. Now, there's 2 big reasons for this. Number one, and actually the less important reason, is that it's nearly impossible to do over a long period of time. The data suggests that only a very small sliver of people can do it. The more important reason is that beating the market is of almost no relevance to your financial goals. Okay, think back to the high school dance or the big fundraiser when you had that poorly drawn thermometer on a big piece of butcher paper, and the red would fill up at every level as people contributed more and more. That's us with our goals. And we have multiple thermometers, whether it be saving for the first home, for a vacation home, putting our kids through college, obviously saving for retirement and enjoying retirement. All right, so we're pushing toward goals, and in American society, which has been blessed by a very good capital market over the last 30, 40 years, we've sort of taken it for granted that the market gives us great returns most of the time, with the occasional big hickey. Well, that's more of a spectator sport. What we need to do, if at all possible, is really focus on our goals and not think about beating the market. It's relatively unproductive, and it actually takes it forces us to take our eye off the ball. As part of the same spirit, trying to pick the best investments, trying to pick the best fund managers. Again, I wrote The Investor's Paradox. It reflects on a 14-year career covering 4,000 portfolio manager interviews that I allocated to or didn't allocate to as part of research and investment teams. And I can tell you that trying to pick the five-star manager is really, really hard to do. Most of the data would suggest that that is, if not impossible, very, very difficult. And like the previous point, it's not necessarily tied to your financial goals, okay? It's an odd quirk of who we are that it's in some ways easier to focus on the near-term jitteriness of the markets than the long-term value in our big goals. Because one thing isn't moving around that much and we don't pay attention to it, and the other is right in front of us and can be a big distraction. Market timing is something that doesn't work. As I've sat with hedge fund managers and other top investors, whether it be in London or New York or Chicago or Hong Kong or Tokyo, and I watch these guys trade, I can assure you that even the best of the best don't time the market particularly well. All right, so the idea that you're going to get in when things go well and get out before things go poorly, don't try to do that. The idea that, well, we bailed when the market was down in 08 and 09, and then you're going to wait to get back in now that the market's up and you want it to correct a little bit, it's another form of market timing that's very, very difficult to do. Again, we want to be allocating toward goals, and having an advisor that has a comprehensive plan is critically important for this. Fourth point, turn off CNBC. Nothing good has ever come from anyone ever watching CNBC. I'm serious. So at an academic level, I can tell you that when you receive a lot of information, you feel more compelled to do something. Because, well, you have this information, you feel like you understand something, and you want to do something with it. Okay, that's just sort of a natural sentiment. So the more financial information that you collect from CNBC or Bloomberg or Fox Business, that is just going to compel you to do something that you probably shouldn't do. All right, remember, this is very much about resisting that first marshmallow so you can get two later. And generally, the people who go on financial television, they're not there to help you. They're there to sell their latest idea. They're there to further their career. But the advice they're giving can't be relevant to you because they don't know your financial circumstances at all. All right? It's just a generally dangerous thing to do. If you find it entertaining, I guess that's fine, but just understand that that is not a place to source good investment ideas. And by the same token, when we do trade on those ideas, hey, Bitcoin's going to be a thing, or social media is the future, so I'm going to be long Facebook, or Netflix is super, and I love what they do, we want to make sure that we distinguish gambling from investing. I'm not saying don't gamble, but please make the mental distinction between one versus the other. Investing is allocating assets wisely in order to achieve various financial goals, like we've talked about, buying a home, retiring, paying for your kids' college, whatever the case may be. All right, that's not the easiest thing to do, but it's doable if you have a plan in place. Versus, having a hunch and betting a bunch. Hey, I think streaming video is the future, and therefore I'm going to be long Netflix. The problem is that, these sorts of stocks can be down 30, 40, 50, 60% relatively quickly, and almost everybody sells low, and then they buy high, as we've talked about. So it's important to make that distinction. And then finally, I would recommend that you not ask for the impossible. Part of what I'm talking about today is how to manage the relationship between client and financial advisor. Okay, so as I've said several times, those who work with financial advisors tend to have better outcomes. But then there's a bifurcation within that community of those that really put some time into thinking, okay, what are we going to be talking about? What's emotionally difficult? Where does intellectual honesty become quite difficult or uncomfortable? These are the parts of the relationship that can always use a little bit of work. And so when I say don't ask for the impossible, what I'm saying is expecting all or most of the upside and none or very little of the downside. It simply doesn't work that way. There are laws of gravity in markets, and there is a relationship between risk and return. Now, I will point out that one of the most dangerous ideas out there is that more risk equals more return. If you want to get great returns, you got to take a lot of risk. That's not true. Like I said, it's a pretty dangerous idea. When you take more risk, what you get is a more variable set of outcomes. And it could be a really good one, or you could go broke. All right, so more risk just means more variability. Now, the converse is different. If you don't take any risk, it's unlikely that you'll have any return. All right, because otherwise you're just buying a lottery ticket for $1 and then you win $100 million. That really doesn't happen to hardly anybody. Okay, so there's a really important relationship between risk and return, and having the right conversation in the right way with your spouse, with your partner, with your advisor is critically important. So let's move on to more positive notes. Things not to do, things to do. The first thing to do is to have a financial plan. If I'm going on a journey and I don't have a destination, it's kind of hard to know when I've gotten there. And having goals and having a plan are two very different things. You could have a series of goals, but unless you have a relatively detailed plan on how you want to get there, then there's a good chance you're not going to meet them. Certainly, if you don't have a destination, you don't know what vehicle to take. Now, I can move forward in a number of different ways: airplane, motorcycle, skateboard, boat. But obviously, different terrains are going to, be beneficial to different sorts of vehicles. So, where you're going to go and how you're going to get there has to be part of a plan. There's a survey done every year of 7,000 wealthy individuals across the globe. And one of the questions they ask these individuals is, do you have a financial plan? In the latest 2017 version, 2/3 of those surveyed said they do not have a financial plan, including those who work with financial advisors. Okay? Because some financial advisors are more focused on beating the market and making hot investments, and they're trying to do well by you, there's no question, but they're not actually planning. I'm preaching to the choir on this point because, as you heard earlier, this is one of the top financial planning firms in the country, and so they're going to have you on track with a whole suite of different services. But it is important to recognize that plans not only need to be in place, but they also need to evolve over time. What we want and even who we are changes over time. I think we can all appreciate that. And so plans evolve. You don't go into a financial advisor at age 35 with your spouse and you set out a plan and you come back 30 years later and say, how'd it go? Right? It's going to evolve over time as life changes in ways that we can never predict. The second thing I want us to do is have realistic expectations on what markets can do for us. Okay, this is my favorite investment cartoon. For those who can't see it, it says, we didn't underperform, you over-expected. Anyone ever have that kind of conversation? In finance and elsewhere? I have. There's a line, my colleague Joe and I, we work for a gentleman who worked for a market legend, a guy named Marty Zweig. And Marty is famous for saying that the market will do what is ever necessary to screw over as many people as possible. The market doesn't owe us anything. It is what it is. The market is the collection of all of us and everybody else on the planet. And so the tough love part of investing and financial advice is having intellectually honest and realistic conversations about what the markets can do, what our investment portfolios can do. And as I mentioned at the very beginning, we lead these money lives of earning, saving, spending, and investing. Investing is the last part. And so depending on what we think we can achieve in the markets, and again, we're guessing, but we can make informed guesses, that has real implications for our savings and spending behavior, and then that becomes, another difficult, in some ways more difficult conversation. Some would say that, what does the stock market give us? Well, I could cut the data to show you the conventional wisdom that the stock market makes 10% a year. All right? I could cut the data to show you something very different. Data is quite manipulated. We can manipulate it relatively easy. So the market returns say 10%, but that's actually not particularly accurate. Permit me to be wonky just for a second and say that what stocks actually do, or what they're supposed to do, equities, partial ownership in companies, is that they're supposed to pay you a premium for taking the risk of not being in a risk-free asset like cash. So there's this notion of the risk premium, and equities like bonds have a risk premium. So you could be in cash and it's risk-free and it just sits there. Granted, the purchasing power is going to be eroded through inflation, which is a different conversation for a different day. But we want to be compensated for the risk. What have stocks done over time? Over the last 100 years or so, stocks have returned about 5 or 6% over cash. And cash historically has been around 4 or 5%. So 5 plus 5 is 10. That's how you get to 10, but it varies so considerably over time. So right now, interest rates are 0 or 1%, very, very low. And so we should have lower expectations. I'm not going to give you a specific number, but we should generally have lower expectations from our equity portfolios and from our bond portfolios. So we're at the tail end of the longest bull market in bonds in recorded history, going back 5,000 years. Okay, so bonds have been an unbelievable investment. If you think about, I vaguely remember, from the late 70s, early 80s, that, you had interest rates in the mid to high teens. And there's an inverse relationship between bond prices and yields. And basically, we've gone from 17% to 0 over the course of 35 years. And in that time, bonds have been a very, very good investment. Well, now we're starting with a kind of a whole new regime. Rates really can't go much lower, okay? And so I'm not here to prognosticate. In fact, we're going to talk a little bit about the fact I think market prognostication is a dangerous thing to do, and it's just a fool's errand. That said, having a realistic set of expectations for how we're going to proceed in the market is, as I go around meeting people, probably the most difficult conversations that clients are currently having. Because the good advisor is going to give you the honest response, and the earnest client is not going to be very happy with that response, but a good relationship is going to center on not only what's reasonable, but how those market returns fit into a more broadly defined financial plan. So this is the one weird idea I'm going to share with you. It's to be less wrong. Okay, that shouldn't mean anything to anyone yet. Let's start with the opposite to kind of get where I'm going here. It's the idea of being more right. Think about just being aspirational people. The idea that we're going to try and thrive, and we are successful by virtue of being in this room. And humans generally, we are the dominant species on the planet by a very, very wide margin. And so we generally, and Americans specifically, we want to be more right. We want to be faster, smarter, better. It's what we do, and it's that joy of competing and winning that motivates us, as it should. It allows us to get to that next level. It allows us to enjoy life in any number of different ways. But there's a flip side to that, which is that as you try to be more right, especially in the world of markets, we can overextend ourselves and put ourselves in a very bad position. And so when I talk about being less wrong, I'm talking about risk management. I talked about advisors being behavioral coaches. They're also risk managers. It's really their job to manage risk first and earn returns second, because negative compounding is a very bad thing. If you're down 50%, you need to double from there to get back to scratch. So you have to be very careful about not losing too much and staying in the game. In my career as an investor, in meeting portfolio managers all over the world, what was interesting to me was that the most prevalent characteristic of the very best of the best that I met, most of whom, they're just sort of, off the grid, they're not really public, but the top feature, and think about the public understanding of hedge fund managers and certain mutual fund managers as sort of Gordon Gekko, arrogant, boastful. No, the best of the best, the number one feature they have is humility. They spend most of their time thinking about mistakes they've made and mistakes they could make. They think about the inevitability of being wrong, because that's just the nature of things. And how do you not get knocked out of the game? How do you recover from those losses that are inevitable? I'm not going to read through all of these, but 3 of the most successful investors ever, unbelievably successful guys. Once we realize that imperfect understanding is the human condition, there's no shame in being wrong, only failing to correct our mistakes. Loss avoidance must be the cornerstone of your investment philosophy. And the fruits of managing risk come only in the form of losses that don't happen. That's a really interesting one. Think about this concept of losses that don't happen. A lot of success in not only investing but in life is the dogs that don't bark. It's the risks that we've either hedged or don't engage with, all right? And so that we aren't going to have those losses. And so what's the most important decision, investment decision anyone could have made over the last decade? It would have been staying involved in the market in 08 and 09 when it felt literally nauseating to watch the news and watch your portfolio on a daily basis. But the non-decision, the decision to stay put, was what's most important. And it's hard intellectually and emotionally to think about the idea that non-events, non-decisions, dogs that don't bark are actually so critical. It's hard to thank somebody or reward somebody for something they didn't do. But so much of success in investing is about this idea that we want to try to think forward a little bit about the risks that knock us out of the game without holding on so tight that we can't enjoy the upside. So Mark Twain has he's many great lines, but one of them is, if I had more time, I'd write you a shorter letter. And so much of the investing game is complicated, and some of that is just the nature of things, and some of that is deliberate. There are people who want this to be very confusing so that you need them to provide expensive goods and services to you. Let's try to write a shorter letter together. If I go to Morningstar, for example, there are 119 investment categories that they have, behind which there are 24,000 specific choices. Now, I go to Baskin-Robbins, I have 31 flavors. I go to Morningstar, I have 119 flavors. And there aren't 119 problems that we're trying to solve. I would actually, in my shorter letter, say there are 3, and this is what we need to focus on. Now, entropy is a thing, like the world gets complicated really quickly. All the noise, all the information. Half of you are going to go home today and watch CNBC. It's okay. I forgive you. We want to boil it down to 3 basic things. We want to grow our assets responsibly by not, take risk, but not too much risk. We want to generate reliable income to meet near-term liabilities. And we want to protect ourselves from market decline or the impact of inflation on our purchasing power. Now, there are hundreds, thousands of textbooks written on each of these, so I can make this, I can go down the rabbit hole on the numbers and make this incredibly complicated. But that's in nobody's best interest. What we want to do is always kind of keep our eye on the prize. Write the shorter letter and say, this is what we're trying to do. And if something with your portfolio doesn't resonate with these 3, then something is amiss. Okay, so it's really important to be asking the right questions when there's so much information to deal with. There's a big literature on the science of happiness. It's written mostly by social psychologists and neuroscientists. My next book's coming out in the spring, and it's on the relationship between money and happiness. And so there's a lot of really fascinating findings. And I want to share one with you today because I think it helps frame some of the way that we deal with the anxiety of our money lives. And it's this notion of the hedonic treadmill. Now, it's an awful phrase, but it's not mine, so you can't blame me. But this notion of the hedonic treadmill basically says that no matter what we achieve in life, including good things, we're always going to want more. Think about the human spirit. Think about our push and our drive to achieve and to enjoy and to win and to compete and so forth. Again, this is part of why we're in the good place that we are, okay? So that's all a good thing. But the literature on happiness, the science of happiness, will tell you, based on extensive studies, this isn't just anecdotal, but extensive studies that we, as humans, are terrible at predicting the duration and the intensity of the joy that we feel when we achieve the goals that we hope to, okay? And it's as trivial as you're going to go to a nice restaurant and have a good meal. And if that happens, it makes you happy in a predictable way, but that kind of evaporates quickly. But it's not the trivial, it's the more important things. It's your kid getting into the college of his or her choice. It's being able to retire at an age that you prefer, comfortably and with dignity, whatever the big goals may be. And one of the challenges that our industry is facing that advisors and educators and coaches are really grappling with is the fact that we have a very strong trend in this country toward longevity. People are living considerably longer. And so when people get to age 65 and their advisor says, you win, like you've done it, you've saved enough, you've been prudent in the way that you conducted your affairs, congratulations. Well, that's great, but increasingly the question is, well, what's next? Okay, so as we live longer, we're going to be grappling with this more and more, and it's just to flag that this is quite normal. It's to validate that sense that even though we get many things that we like, that we're always feeling, what's the next thing? That's very much part of who we are. So last real slide, Willy Wonka is one of my favorite movies of all time, not the new one with Johnny Depp, which is terrible, but the old one with Gene Wilder. And through my behavioral finance lens over the last couple of years, as I've watched it with my kids multiple times, it really strikes me as a cautionary tale. Okay, Augustus Gloop falls into the chocolate river, Violet Beauregard becomes a blueberry, Mike TV disappears into the radio waves, and Veruca Salt, falls through the chute as she literally chases the golden goose. And these 4 kids represent the ones that wolf down the marshmallow, literally and figuratively. And their parents are obviously enabling. And off to the side, you have this sweet boy. You have Charlie, who has the everlasting gobstopper. And at the end of the day, he gives it back, and he gets the entire chocolate factory. Okay? I'm coming back to this theme a couple different times because it's so important. One of the distinct features of the human is that we have an ability to think through time that no other creature can, okay? You and I can say, hey, next Tuesday, let's meet in Bellevue at wherever and have a beer, okay? There's nobody else in the world who can do that can think that way. And so that ability to transcend time is also part of our survival story, our victory story as a species. But at the same time, that brain that zips around, going forward toward imagination, going backward toward memory, it makes it quite difficult to live in the now. It's not surprising, and I see it in Chicago, I see it in Seattle, I see it in every major city, yoga, meditation, all these sorts of activities that allow us to find presence because our brains are being so assaulted by the amount of information that we're finding. Interacting with, that we're trying to kind of have that Calgon take me away moment. So as we map the old school brain onto new school markets, there is this mismatch. So that ability to resist is important. The ability to work with your advisor and understand where they're coming from in that process is just critically important. So just by way of conclusion, have a long-term plan. By virtue of sitting in the room, you guys have checked the biggest box of all, and so congratulations on that. Have a realistic expectation for what markets can do for you. Remember, markets aren't a they, and they don't owe you anything, but we can still have reasonable expectations and calibrate accordingly. Be less wrong. It's my weird idea, but that notion of putting risk first and return second is what puts the best of the best in the situation they're in, okay? The best of the best are not Gordon Gekko. The best of the best are the guys who just sit at their desk and worry about what's going to go wrong, but then enjoy life when things go well. Ask the right question, write your shorter letter, all right? Growth, income, protection. To state the obvious from our chat today, this is really an emotional business. I so strongly believe after 20 years in this industry that it's the psychology and not the finance that drives long-term success. What we really want to do is underwrite a life of meaning. There's a difference between being rich, which I define as having more, and being wealthy, which is funded contentment. It's that ability to underwrite a life of meaning, however you choose to define that. Your advisor is a senior partner in that quest. And so we have to understand that is a deeply emotional, that is just a very big thing to deal with. And then lastly, outsourcing complexity, which is merely to acknowledge that no one person can do it all. We do it in every walk of life, right? We have lawyers and gardeners and a waiter or a waitress, and there's a big division of labor. So recognizing that we're going to be excellent at whatever craft we choose to be, and that we're going to rely on other experts and trusted partners to help us out along the way is just an absolutely non-negotiable part of success these days, given the volume and complexity of capital markets. So this is like a really amazing group of clients you guys have put together. Congratulations. Everyone with the smiles and the head nodding, I love it. I don't know if we have time for questions, but I'm going to stick around for a little bit as well.